I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.
Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Anna Kelley. Anna has ownership in and asset management of over 1,200 multifamily units across the U.S. She's invested in over 2,000 doors. Anna runs a multifamily syndication company, Greater Purpose Capital, and she's focused on creating meaningful impact on the communities in which she invests. So Anna, thank you so much for coming on the podcast.
Thank you so much. It's my honor to be here with you today.
I'm really excited for this conversation. I would love it if you would just start with kind of telling us your story, give us your background, where you came from, how you got to such an impressive portfolio. I think we'll have stops along the way and talk about certain things, but I think it's nice to just let the listener know a little bit about your background.
Sure. So where do I start, Jason? I'll start with this. I was not one of those that was born with very much information about wealth or real estate. I actually grew up in Section 8 housing in apartments in San Antonio, Texas. And my mom was a property manager for our apartment complex. I basically just wanted to figure out, how do I create enough money that I can get out of living in Section 8 housing when I grow up? And so I wasn't thinking about real estate, knew nothing about it. I worked hard and got an education and came out of college, and I was offered a job at Bank of America in their private banking department. And so I started learning about, what do we tell wealthy people to do with their money so that they can grow wealth? So it was interesting. I was talking about learning about wealth, teaching people about what to do with their money once they had it. Our clients had the top 10% of the wealth in the bank, but yet I had no money and I knew nothing about how to get it until I was 65 years old, right? So one day, one of my very wealthy clients laughed at us. This was at the end of the 90s. And I told him we could make, I think, 8 or 9% in a CD. And he laughed and said, honey, I make a lot more than that in my real estate investments. And I thought, well, that's really interesting. I had never heard about real estate investments, knew nothing about it, knew nobody that owned real estate. And it was kind of an aha moment that one day, if I ever get wealthy, I want to own real estate. So fast forward several years, I had my first child in 2003. And I knew that I wanted to figure out a way to be home with him. And at that point, I worked at AIG in Houston, Texas, had a very nice 6-figure paying career. And I was very driven to accelerate my career, but I wanted to be home with my child. And I didn't know how to do it because I was basically the sole breadwinner, because my husband had just gotten out of chiropractic college and was interning with 6-figure school loans. And so at that time in 2003, all of the Flip This House shows had just started. And we watched a couple and said, how hard can that be? It looks really easy. Let's flip a house. Yeah. So with a 3-month-old baby in 2003, we flipped our first house. We had no idea what we were doing. We made a lot of mistakes. We lost a bunch of money. In total, it took us a year to flip the house and we lost $10,000. So it could have been a lot worse, but it was bad. Right. And my husband said, we are never, ever doing that again. So I thought, well, okay, we've kind of tried. But at that time we had a rental. We had a rental in the back of this property we were flipping, and the tenant was paying rent every month. So we're like, thank God we had that tenant paying rent while we were flipping it and it holding for a long time. And so at that point, Jason, fast forward to 2007, we decided, my husband needs to start his own practice. Entrepreneurship is the way to wealth, and I need to get home with my kids. At that point, I had 2. And so we moved to Pennsylvania in 2007 in February, height of the economy. Everyone told us the economy's booming. It's never going to stop. It's a great time to start a business. And we went into significant debt, about $300,000 to start up his business. And we bought a building. And that building, Jason, was the best decision that I ever made. So instead of leasing space, we found this mixed use property on Main Street in this small little town. And it had a office space on the bottom, and it had 3 apartments and 4 garages. And again, I wasn't really thinking about real estate wealth, but I thought it's probably a good idea to buy this property that has other tenants paying rent, just so that we can be safe in case his business doesn't do well. And 95% of businesses end up closing in the first 5 years. So fast forward a year, we go to 2008, the Great Recession. At the time, I worked for AIG. I found out the week everything was crashing, I was pregnant with baby number 3 and lost about 3/4 of my 401k. And it was a devastating week. We thought, we tried to do everything right. We lived on one income. We followed Dave Ramsey. We paid off all his school loans. And we actually also house hacked a 4-unit. So after we bought that practice, at the beginning of '08, we house hacked a 4-unit. We took a huge step back in our lifestyle to, be careful. And we had these tenants. And what happened at that point, early 2009, I had this aha moment that I worked for one of the largest companies in the world, and it was going under and not safe. My 401k that I had invested, I thought very wisely, was just about wiped out. And the only thing that was still going well in the Great Recession was my tenants were still paying rent. And that aha moment made me say, I have to take control of my finances. I took the very little bit left I had in my 401k, and I bought another 4-unit across the street and thought I'll make about $1,000 a month that I can cover the cost of diapers for this new baby number 3 and basically our living expenses. We may have nothing else, but we'd be able to survive. And so that was really '09 was when I said, okay, real estate's what I'm going to pursue really with everything I have, rather than just dabbling like I had over the years in order to create financial freedom. And, this time it's been about 13 years, but I was able to create significant wealth through real estate, retire from AIG after 20 years. And, now I've owned about 1,600 multifamily units as a general partner, and several $1 million in personal real estate, and about $200 million in real estate overall with partners. It's been an incredible journey.
Yeah. I love that story. I think there's so many things, sort of like we touched on before we started recording, like what gets me excited about other podcasts and doing this podcast is kind of hearing stories like that, because every piece there that you shared is like all of that goes into it, right? Even growing up in Section 8 housing, like I didn't grow up in Section 8 housing, but we probably should have. Like I don't know if my mom just didn't know that was available, or it was pride or what, but like we should have. And and you said something that like really resonated with me, in that you're like, I need to figure out how to like it impacts you in such a way that you're like, I need to figure out how to be that owner, to be the person that, like the people are, you don't want to be the renter anymore, right? And so
Right.
you want to be on the other side, because you see what that's like when someone else is kind of in control of your housing. And
Absolutely.
so I think that like I said, it really resonated with me. Similar feelings as a as soon as I sort of got out of school, I was like, I want to own, I want to buy my own house. I don't want to rent, that kind of thing. And I bought like the worst house I could find because I could afford it. And it was like, whatever, I'll take it on. And
Yeah.
all the stuff that you did, I don't know if you were looking at yourself as a real estate investor, kind of in the beginning. You said you were dabbling, you kind of, but as you said, like all those things worked out because that's what happens, right? In real estate, like if you just get in there, that's what happens. It works out.
Absolutely. My very first property I bought actually was in 1998, the end of 1998. And it was after that investor said he makes more money in real estate than anything else. I thought, I may not have a lot of money, but I have a really, really good paying job for somebody that was just out of college. And I'm throwing money away at rent. And I have some friends that are buying houses or condos. They're a little older than me, but I decided to buy a little 1-bedroom condo just so that I wasn't throwing money away on rent. So my first real estate purchase on my own, I was single, and I just thought this is a wise way to have some equity that's being built up, mortgages being paid down, and my expenses were actually much cheaper than renting. So my first lesson was really learn to live below your means while you work to expand your means. And that's what I was focused on. So I wasn't focused on using real estate as the way to wealth, but I knew that if I didn't have to throw money away at rent and I owned something and it was starting to go up in value and it was mine, I was basically paying for my own property. I knew that that was a wise step. And so for me, real estate was just like, let's use this as the next step to try to get ahead. And then it was a flip and a little rental. Once I had tenants, again, I wasn't thinking I'm going to create real estate wealth this way. But the other thing that I did when I did decide to have some apartments and to live in our little 4-unit, after everything crashed, I couldn't get loans, right? Because not only did I work for AIG, which was in the news every day that it was going to be going under, we were like $2 trillion in illiquid, basically, and needed a government bailout. But my husband's business was struggling. It was a startup. And I thought, well, I've got these units. I'm buying this third property. I need to figure out how to maximize the income. And so I bought a book called Multifamily Millions by Dave Lindahl. It was the only real estate book that I read for probably 5 years. And I read that book and it was this aha moment that, wow, not only can this real estate cover my expenses and provide for us if I lose my job, but I can actually learn to make the units nicer, raise rents, cut expenses, force the appreciation, essentially making it worth a lot more. And then I can start trading up over time. And he had these graphs of how over 10 years, you can take teeny tiny little properties, buy them one at a time, roll them into the next one and create wealth. And I thought, okay, I'm going to try it. I mean, I have nothing else to lose at this point. So while the banks all said, Anna, we just can't lend to you. We're not lending to any real estate investors. Your husband has hundreds of thousands in debt and not enough income, and your company's about to go under. And so I realized I'm going to have to figure out this thing on my own. So we put a lot of time, Jason, in just learning to have properties and fixing up our own rental units, knowing that eventually they would be worth more. And eventually the banks would say yes and start letting me borrow for my equity to buy more. So it was a very slow, patient, methodical learning process to just say, I'm going to take an action. It's not a perfect action. I don't really know what I'm doing, but it's better than not doing anything. And that has served me really well over the years.
Yeah. And it's a great point I think a lot of people just, I don't know if they don't have the patience, they don't, whatever it is, they don't believe it's going to work, but it's like what you just talked about, sort of that beginning and how you couldn't get a loan. And also it was, I mean, the timing in terms of the grades wasn't great timing, but like, even despite the fact that it was, some people might have looked at that as the worst possible time to get into real estate. The fact was a lot of people that did get into real estate then have been hugely successful because they got in there when it was a buying opportunity. And I just think so many people look for the reason not to, right? The reason,
Absolutely.
any reason not to. And it's like, I just love it how you just figured it out. You're like, okay. And then what people need to see here is, okay, so, that was in 2008, 2009, here we're 13 years later. And now you've been involved in $200 million of real estate. Like it does, that's not a long time, right? 13 years is not a long time in the grand scheme of life. And if you had if none of this had happened and you had just worked at AIG for 13 years, you wouldn't be in that position. You wouldn't even be close to that position. You would just have a job. And so I love that. Like, it sounds like a short little story, but like the reality is you put a ton of work into it, all that went in, and then essentially created this empire just by believing in it in the beginning.
Yes. And it was hard. I can tell you, I remember standing in my living room in early 2009. I'm sorry. Yeah. 2009. and bawling and, being pregnant and finding out my 401k was wiped out. And everything that I had been taught about money at Bank of America and at AIG was proving to me not to work if the timing wasn't perfect, right? So we're told it's always going to bounce back, always stay in the stock market. It's going to come back, and just don't ever sell, when it's low. And there's truth
Right.
into that. You buy low and you sell high. And that's part of why it worked really well for me for real estate, is because I started really buying when it was, cheap, although it was hard to find the loans. But I realized I had invested in a lot of companies that were never coming back. They were financial companies, and I had seen friends get wiped out when Enron fell a few years earlier. And my grandmother lost half of her wealth when MCI WorldCom fell a few years before that. And, I saw all these heavy hitter financial stocks I was in start to fall. And I realized I have to take control of my own finances. And I was looking at real estate as an investment that would pay me cash flow. I wasn't looking at it at that point as I want to create wealth. I'm like, I just need to survive. And entrepreneurship isn't working. AIG, my job isn't as safe as I thought it was. And my 401k is gone. I've worked so hard to do things the right way. And guess what? The world doesn't always give us the reward for that. I mean, we were better off because of that, but it wasn't enough. And I had to basically said, am I willing to shift everything I thought I knew about money, in the few years that I had worked with really high net worth investors? And am I willing to commit that I need to learn more, because what I thought I knew wasn't everything I need to know? And so I realized in that humility of losing everything that I thought I was really smart to that point. I was able to look back and go, hey, I got a 6-figure paying job. I'm working with the wealthiest of the wealthy. We have our own, company. We're doing pretty well. And I realized that I knew so little about economics in general, and expansions and recessions and these highs and lows in the market, and how that could impact me, my life, my livelihood, and my investments. That I said, I've got to take a step back, start from the beginning, and learn what I can about money, and learn how to take control of my finances in things that I have more control over. And that's the thing that I loved about the real estate was my tenants were still paying rent. What I could do is I could make my properties always look nice, be nice to my tenants, and collect cash flow. I wasn't putting my finances in the hands of companies that I knew nothing about that could go under any day. And so just that mindset of I've got to take control. I've got to start over and learn everything that I can. And then I've got to have the grit to stick to it. And, in Texas, we have this saying with women, you get out of the mud, stop wallowing in it, put on your big girl panties, get on the horse and ride. And that's what I kept saying to myself as I'm like, the world is ending. We're not going to survive. This is terrible. I had those moments, but I was like, I've got to get up. I cannot wallow in the mud. I got to fix this. And I'm just going to get on and I'm going to ride. And I don't know where it's going to take me, but I'm going to make one smart decision financially day after day after day until it pays off. And I can tell you, I had to talk to myself over and over, because there were periods when it was extremely hard. At that time, I worked full time still. We were told we were going to lose our jobs, but I had a very unique position that was really hard to replace me, thankfully. And so I kept my job, but I was pouring into my husband's business, rehabbing our properties. At this point, I had 4 kids over this 13-year period, and it was hard. I worked 70 to 80 hours a week, probably most of the last 10 years before I retired. So it was not easy. It seemed to take forever, but I saw a lot of people give up and drop out of real estate when they couldn't get loans. And I said, I'm not going to quit. And so that resilience and that grit is more important, and the humility to learn something new and just take action than exactly what it is that you buy in real estate, what kind of niche you go after. None of that really matters. Just take steps, educate yourself, and believe in yourself until you find success. You just don't give up. And I really think that's the formula for success in real estate and anything else.
100%. I mean, that the formula and success for basically anything you want to do in life, really, you could, sort of sum it up there. And
Yeah.
it's just, God, so much good stuff there. I mean, it's that willingness to take action and really just kind of make it happen is just so important. You touched on the control aspect of all of this, and you said like the stock market, we have no control over it, right? Like you can think that you're picking a good company and you can think that you have some idea of how they're going to perform, but the interesting thing to me about the stock market is you can pick the good companies, but if someone hears something in the media that they don't like and it causes this mass sell-off, it doesn't matter if it's a good company. It's happening right now. The stock market's plummeting. The companies are the same. Like they're all of this stuff is based on speculation and like the consumer sentiment. A lot of it is just that. And so your stock portfolio can change dramatically just based on, as we've learned, a tweet from Elon Musk. Like literally a tweet from Elon Musk can either make you a bunch of money or lose you a bunch of money. And that's not going to happen in real estate. It doesn't matter what Elon Musk says about to anyone. With your portfolio, you're in control of it, and you can create this for yourself and for the people around you, your investors, your family, all of that. You have the ability to impact others at sort of at your fingertips. And it's like, I think, as you said, like what we get taught is so wrong for actually really getting ahead and creating wealth and freedom. It's just really almost the opposite of what you should do. It's just, I guess I don't know the reason why it's taught that way. I really don't.
No, it's hard. It's because that's how it's always been done, right? And we have this phrase that we put at the bottom of every investment. The past is not indicative of future performance, and you can't expect this in the future just because it happened in the past. But everything that's really taught does teach you to kind of expect what happened in the past. And there's some good things that financial advisors will tell you. The whole dollar cost average, just keep investing, try to buy low and sell high. But it's really tough to time the markets. And when you have huge market disruptions that aren't specific to a particular company, it can bring the entire system down. And that's what I had never been taught that, right? We looked at the Great Depression and said, well, that'll never happen again. We looked at the crash of the 70s and the savings and loan crisis in the early 80s, and we were taught that would never happen again. Legislation was put into place to keep it from happening. But what was really interesting is that at AIG, I worked in a division where we did hedge fund private placement investments for the ultra high net worth. And so I sat in meetings listening to what their advisors wanted in our products and what we needed to do to give them. And they all, once their income needs were met, they were able to take a lot more risk with their money to invest in things that could have great performance, but they could lose it all, right? But until you get that wealth, we as normal American, blue collar, white collar, middle income America, we're not investing and creating enough income that we can take the risks with our money for massive growth in the stock market. And if consumer sentiment tanks it, we're okay. We're relying on all of that stock market's growth and income to happen such that when we're 65, we can retire and then we can kind of live that lifestyle. And I realized that while I was poor, I was telling people what to do with their money when they had it. But no one had taught me, how do you really grow wealth, not just slow and methodically and have to wait till we're 65, but how do you, when you're a mom, get to stay home with your kids? How do you truly produce additional income to create financial freedom when you're young, when your kids need you the most, when you need your time freedom the most is when you're young, not when you're 65. And by then your kids don't want to be around. They've got their own kids and they're, going to school and they're too busy. And so I saw so many people in their retirement ages, sad and alone, but they had a lot of money. And I thought, there's got to be a better way to do this, right? And so truly reading the book Multifamily Millions, after I had started, realizing that some of this passive income from these rents is smart, it's protecting us, it's going to cover rents if we can't pay. I realized, wait a second, we're producing enough income to be really close to replacing, a third or a quarter of a year income. I can leave if I just buy a few more of these things quickly. And so it's one of the reasons I'm such a huge proponent of education. And when you mention, purpose and really being able to impact, now coming from Section 8 to now owning, literally a couple thousand, 2,000 now I've had ownership in apartment units, and being able to go back into my communities and say to the single moms that are struggling right now in this economy with high inflation, here are some financial tools and resources you can use to learn how to expand your income, live below your means while you work to expand your means, and give them the hope that if someone like me could do it, they can do it, right? And so for me, that's what it's all about, sharing my story and just being able to grow now with the abundance that I have, being able to go back and create that education that just is not there for most Americans.
Yeah. Oh, I mean, absolutely. It's that education isn't even there for the people that have access to good education.
Right.
Like, let alone the people that don't have access to good education. I mean, it's just not being taught. And so
right.
I think it's a huge thing that you're, sort of giving back in that way. And I feel like the education component, like trying to let other people know the power of this, especially young people, because they have the power of time, is like, it just keeps becoming more and more important to me, to like, probably so much so that people are sick of hearing it. But it's like, I'm like, listen to me, you've got 20 years on me, like, do these things. It's simple. You can start little. You don't have to, think about this like massive growth. If you start early, you just buy one duplex, one quad, something like that,
Right.
and just
Right.
get going.
And that's the best advice that I give people as well. The American dream is you get a good job and then you buy the big house with the white picket fence. And once you're stable, then you have your kids. And what happens is the dollar catches up with your income, and all the debt from the house and the cars and the kids and your education. You never have anything extra to be able to start investing. So the problem is that we are impatient people as a society, and we have the pressure to try to look like we have it all together and build this life first. And then we get into the grind and we can't pay for it, right? We're trading our time for dollars. And so the higher the nut is that we have to crack, the higher our living expenses, the more we have to trade our time to make more money just to cover the debt payments. And so, I tell young people, as soon as you can, save 3.5% down and get an FHA loan on a 4-unit apartment building, a 3-unit, a 4-unit, whatever's in your area that's a multi-unit. Live in one of those units and have your tenants pay the rest. Then you're living below your means, right? You've got people that are starting to pay you rent, and you're starting to produce that extra income very young. We delayed gratification. And that's, there's a power in delaying gratification. And while living below your means isn't going to make you wealthy, it's the foundation for starting. If you already don't have wealth, don't go out there and listen to the people that say, oh, you're living with a scarcity mindset. No, you want an abundance mindset, but first you have to live below your means so you have something left with which to invest. And so, I just kept learning. I just have to take a step back. And I'm very thankful that I actually did come from humble beginnings and lived in apartments most of my childhood, because it taught me that I can be content whether I have the big house that I did buy in 2000 or whether I have the little bitty apartment. And I knew that taking a step back for a short period of time would allow me the extra income I needed to start slowly and methodically saving down payments to buy more rental property. And Jason, we lived in our little 4-unit apartment building, a 2-bedroom apartment with 3 kids, for about 2.5 years. The year before that, we lived with my in-laws for a year when we first moved to Pennsylvania. And then instead of buying a house when we could, because we had just lived through this, terrible time in our economy, I said, we don't need to buy a big house yet. We need to continue to figure out how to buy more real estate. So we rented a small house for another 3.5 years while we saved down payments to put down on buying more cash flowing properties. And once I retired, we had enough cash flowing properties producing, really good 6-figure income and could pay for our house payment. But we took 7 or 8 years of renting and living below our means to really grow that wealth to the level that I could retire And then the last 3 years, I've been full-time, actually 3 years exactly, I've been full-time. Of course, I've been able to exponentially grow my wealth once I went full-time, but I never could have done it if I had followed the American dream path of going into a bunch of debt so that I could have all of the quote unquote stability before I had kids. We knew that didn't work because we lived through it by experience.
Yeah. And it's the point about, sort of the scarcity mindset and the abundance mindset. It's not, scarcity mindset doesn't mean that, or excuse me, an abundance mindset doesn't mean that you should just buy a bunch of luxury items. That's not the point of that.
Right.
But the abundance mindset says that there's plenty of money out there through which you can grow wealth.
Yes.
You don't grow wealth by taking on bad debt and, consuming items, stuff, right? So it's like that's that living below your means, that, sort of being content in a smaller house. And it's so funny. Like, I feel exactly. I've said this to my wife. I'm like, I could be poor. I was poor. It's not even really, yes, like we want to grow the wealth, but it's almost like I want to so that we can make a bigger impact. I don't need stuff. I don't need, like, I don't need more stuff. It doesn't, we have plenty. It's fine. And we could, but the things I feel I can teach my kids and the things I feel we can, sort of give back and have impact by growing the wealth is like, that's really meaningful. So it's a very exciting thing to look, I look to the future to be, in a position that you're in at this point. I mean, it's really just very cool and inspiring, like, outlook on the future. So I really do. Let's actually just kind of talk a little bit about your portfolio. I know you didn't get to 2,000 units by buying, duplexes and fourplexes. So when did you kind of make the switch into, sort of larger multifamily and growing that process?
Sure. So I will say this, bigger number of doors is not always better, despite what you'll see in Facebook and in conferences, some of which I've spoken at, right? We think that in order to do really well, really fast, you have to scale and you have to own lots and lots and lots of units at the same time. What I can tell you is that real growth, real wealth growth and income that you can depend on if you're trying to replace your income depends on properties that you own 100% or you own a large percentage of with just a couple of partners. And so I started out buying 4-unit apartment buildings, and there were a lot of them in my area. Where I grew up in Houston, there weren't a lot of those, right? But there were a lot of them in central Pennsylvania. So I started with where there was opportunity and where there were buildings that not everybody else was buying. And 4-unit buildings was kind of that thing in my market. We also flipped some houses. So saying, we would never flip again. I convinced my husband we should flip again. And we flipped some houses and we took the equity and then we went and used that as down payments for other properties. And so I bought, and then we kept some of them. So we learned it's not smart to sell all these. We need to just keep them as rental income and take the equity through an equity loan to use as the down payment on the next one. So we bought singles, duplexes, quads, primarily quads, and we would buy one, fix it up, raise the value, take an equity loan, a second mortgage on those, use that to continue to put down on the next one. And we might make $40,000 or $50,000 on each one of those in increased equity that we could borrow. And that only afforded me buying another $200,000 to $250,000 building. And so in my market during that time, that was 4-unit apartment buildings. And so I bought what I could afford to buy on my own, because I needed that income. I needed to be able to rely on it. If I had gone up and syndicated those deals, even though I learned about the syndication through Multifamily Millions and some other things I started reading, several years after I really got started, I knew that those were short-term deals that don't pay a lot of cash flow, right? So the syndication model, you're essentially bringing a bunch of investors in, you're buying big apartments, and you're going through that forced appreciation process where for a couple of years, you're decreasing your occupancy, you're increasing your vacancies, you're renovating these units. And so the cash flow is not very good during that time, but you're hoping that you've created so much value that you can sell it in 2 to 3 years and get huge chunks of cash from the wealth and the growth that you've created. And so that model I knew was not congruent with my financial goals. And this is what I say to people is so important is, what are your financial goals? Is it income? Is it growth? Or is it preservation? And it's almost always one of those three over our lifetime. But when we're getting started, if we need income and we're trying to replace our income and work ourselves out of our jobs, we need properties that we can bank on creating that income for a decade or more, right? So I wanted small properties I could keep I could rely on that cash flow coming in. I was creating the wealth and the forced appreciation, but I was borrowing against it to buy the next smaller property. So I knew syndication was a good way to get big chunks of cash, but it was transactional, and I'd have to do a lot of these deals to get a paycheck at the end, every 2 to 3 years. And you get an acquisition fee up front, and a lot of people live on the acquisition fees, and then they hope that they do well and get the money out at the end. So I focused only on the small properties because I knew that syndication was for a growth model and I needed income. After I made the decision to retire, to leave AIG, and this was about October of 2018, I knew that at that point, since I had created enough rental income from all my smaller properties to replace my income, pay for vacations, pay for our health care, and have a little bit of extra, I knew I'm going to give my notice, but I need to do a few things to set me up to feel better about letting go of this job. Because believe it or not, by 2018, AIG had bounced back and I was doing well again. And so essentially, I decided in about October of 2018, I'm going to do some joint ventures. I want to buy some bigger apartments than what I've been able to do on my own, but I want to do a joint venture because I want to hold them for about a decade. And again, be able to rely on that income for 10 years instead of 2 or 3. So I found a 73 unit off-market apartment building in my area, and I didn't have the money to take it down, but I knew if I could negotiate it and get it off market, I could find the money. And so I put together a deal at the end of 2018 with 2 partners that we joint ventured on. And since then, we've done 5 joint ventures together. So we own about 240 apartments together, me and 2 other partners. That I just started doing really at the end of 18. And then once I left my job at AIG and I had 2 bigger joint ventures, about a little over 100 units in joint ventures together, I said, okay, I've been in the financial world for 22 years. I know how to talk to high net worth investors about money because I was essentially working on wealth development products for 22 years. I know how to operate small apartment buildings. It's not any harder to operate bigger ones. In some ways, it's easier because you've got more units in one location. Now is the time for me to scale up and start syndicating. And so I started syndicating about 3 years ago.
This is like anybody listening to this when this comes out needs to take that section and like play it over and over again, because so many good points. And so like that's the recipe. That's exactly the recipe. Like you don't have to, you can have your job, you can do the smaller deals on the side. But your point about the ownership part, like many people in syndication, as you said, like you talk about more doors and growth and scaling. And it's true. It's true. Like if your goal is to say that I have thousands of doors, you're not going to do it by buying, fourplexes and duplexes and stuff. You've got to get apartment buildings. But in terms of what cash flow you're going to have, or even how much of the equity you're going to have, if you're syndicating and there's like 6 partners or more, some people get a ton of partners on the general partner side, that sort of extra is spread very, very thin. The cash flow really comes from the limited partner side, or it goes to them first. So you have to know what you need. You mentioned, there's those 3 components. You have to know what your goal is. If your goal is cash flow and you want to live on those real estate investments while you own them, syndication may not actually be the right thing for you. If you're just looking for growth in your net worth and equity, then maybe it is. But the point is, like, that stepwise progression of sort of working up through the way that you did is perfect. Like it's exactly what like almost everybody should do. It makes a lot of sense.
Right. But it's hard because, again, kind of back to that, we live in this microwave society that thinks, faster is better and bigger is better. We see what looks like super overnight success from a lot of syndicators, right? And I can tell you a few things. And I am a syndicator, so I know I'm kind of like knocking my profession a little bit here. But I took syndication very seriously and very methodically. And I can say that, yes, I've made a lot of really careful, cautious, thoughtful, wise decisions with my money since 2008 and 9 when everything was crashing. But the market also gave me what I needed at the time because I was starting really low, and a market that's rapidly expanding and growing and bouncing back from the prior financial system collapse allowed us to have rapid growth in the values of our real estate, right? And we've kind of come to the end of that expansion period, a decade of expansion that allowed people to get in to syndications at a cheap point, not even have to do it all perfectly, and be able to end up in a year and a half or 2 years with something worth $1 million or 2 or 3 more than they thought it would be. And we look like rock stars, right? And it looks like, man, we just got to keep doing these big deals because that's where all the millions are made. The reality is, again, all of it's kind of separated out. So you're getting a small piece of it, and it's not chump change. It's good money for extra, for growth. But what I did is every time I made money on a syndication, I turned around and put all of that money back into buying a small property for my own family's portfolio, because that's where the long-term wealth is built, right? That's where that long-term, now I've got that chunk of money. I can now buy something else that's going to create me cash flow for another 10 or 20 years. So I actually prefer the smaller properties, and on $1 per investment and $1 for the hour of my time put in to create that worth, I make significantly better returns on my smaller properties, Jason, than we do on the big ones. So just think about that. And I would encourage all of you listeners, if you're thinking about getting involved in syndications, or you're trying and it's really hard right now because deals are trading at $1 price that you can't cash flow without taking on significant risk and bridge debt, variable short-term debt. We are at the end of this expansion cycle. And the thing that I didn't understand in 2008, the reason I was blindsided despite knowing a lot, I thought, about money and the financial system, was because I didn't understand what had happened to run up to 2008 and this kind of asset bubble that we were in as a country. And I see very similar things right now as to what I was seeing in 2007, but now with the lens of what happens when you have a bottom. It's fueled by cheap, easy money and low interest rates. And there's this rapid expansion that creates this quick wealth. Now we're on the verge of the bottom of that, right? And we could be starting over at the bottom. And so this is a time not to get frustrated and say syndication doesn't work, or it's too hard, or you don't have enough money, or the deals aren't there. But say, listen, things are about to get a lot worse. That's not the time to get scared. It's the time to start educating. And when things are a bit cheaper, and I don't see a real estate crash, but I do see values kind of leveling out and some areas coming down a little bit. When real estate gets cheaper and everybody's afraid of it, that's when you say, okay, now I'm going to go all in and start buying yourself small properties and ride the next wave up over the next 10 years. But don't think you're going to start big now and you're just going to make a lot of money, because anyone that's starting in syndication now that already doesn't have a lot of experience, you could be in for years before it pays off and trading a lot of your time for not a whole lot of money if the market doesn't keep bringing values up significantly over the next couple of years like it did before. You're probably much better off slowly and methodically buying small properties alone or with a couple of partners as a joint venture that you can depend on that income and still force the appreciation. And then when the time is right, start thinking about scaling up to bigger deals again.
Yeah. Yes. Perfect. That's all like incredibly good advice that people should listen very closely to. I don't have anywhere the level of experience that you have, but it's kind of being in the space that you can see kind of what's happening. And I wasn't really doing real estate in 2008. I guess I didn't think I was doing real estate. I had bought a house and fixed it up and done all that, refinanced it twice, and like made all, because everything was crazy growth at that time, right before 2008, and I sold it right before the crash. Like, I got lucky, but yeah, those same things are happening, and it's happening on both residential and commercial real estate, where it's just, people, and not to take away what people have done, but there is some luck to it, in the sense that if the market goes up as much as it has gone up the last 10 years, like, that's incredibly helpful to your to your growth. So it's
Right.
just, it doesn't mean that people aren't doing the right thing, and you need to make the decision to get in there during those times.
Yes.
It's just also the market helps, and that's what we all hope for. You hope for it when you invest in stocks, you hope for it when you invest in real estate, that the market's going to help you. But at the same time, with real estate, you have some ability to control that as well. You can force appreciation and not completely rely on the market.
Absolutely. And if you already have properties and you're having a hard time finding more cash flowing properties, because that's the biggest issue that my coaching students come with me is, I want cash flow. I'm investing for cash flow. There's no deals that cash flow. And it's because we're kind of in this peak period of irrational exuberance to go into stocks and real estate at the tippy top of probably the market. And you kind of get sucked into doing deals that don't actually meet your financial goals, that aren't cash flowing, just to say you've done a deal, right? And so I tell people, just slow and methodically move the needle. You're not going to be able to just have a home run every single year during, economic growth and activity, but just keep buying, slowly, dollar cost averaging, like we do in the stock market, buying one rental at a time, slowly and methodically, but only buy if it actually meets your financial goals. And if it doesn't, take that time to do something else to increase the income. So for example, Jason, some people have properties, they haven't really forced that value add. They haven't put in the money into their properties to maximize the rents and maximize the values. So before you try to buy something else that really isn't cash flowing, spend some of your time reinvesting into your own properties, getting the rents up on your own properties, forcing the values there. Then you'll have some more equity available if you can cash out while rates are still historically low. Although that time horizon shrinking quickly, right? Take that cash and then be ready for when we do have an economic downturn, that you'll have some better liquidity and some better experience to take advantage of things when the moving the needle will just go much more quickly, because you've got, less people buying those same properties at hopefully, somewhat lower prices. But study not only real estate, but study the economy. That's my biggest suggestion. I was blindsided because I really didn't understand a lot of the financial considerations in the market that could impact my ability to raise rents, could impact my job and my salary, my cost of living, my tenants. So start studying the economy and seeing where we are. Are we in an expansion period, or are we in a contraction period? Are we heading toward recession, or are we heading toward growth? And when you know those things, while you can't time the market perfectly, none of us can, you can kind of see the signs of where are we in a massive market cycle, and the decisions that we make and what we should buy should help us shift into, okay, well, if we're in a market cycle that's not going to produce cash flow, maybe I need to not retire quite as quickly. Maybe I need to keep my job a little bit longer, and I need to slowly, methodically move the needle and buy some things. And if we're at the bottom, that's when you get rapid. And if you're at the top, you go, I can't time it perfectly, but now's the time to start selling or cashing out my equity so that I can capture it before values potentially come down. So we're actually selling 4 of my 5 large multifamily syndications now, because it's the time to sell, not the time to buy. And then when we take that liquidity, I'm going to sit on it slowly and patiently. And when things collapse a little bit, probably, then we will start, the whole process all over again.
Yeah, great advice. Let me switch gears here so that I don't keep you all day, although I love this conversation. I like to ask every guest 4 questions, and so we'll start with those. The first one is based on the name of the show being Know Your Why. So Anna, what is your why? What drives you and kind of keeps you motivated?
Absolutely. So my company, Greater Purpose Capital, our tagline is investing for meaningful impact. And it's not lost on me that I really believe God's brought me through everything I've been through in life, from my growing up in Section 8 housing to struggling through a recession, through growing wealth, to really be able to go out and impact other people. And sometimes that's my investors who I'm teaching about financial education so they can make wiser investment choices to grow their own wealth and create their own time freedom by creating the passive income that allows that. But it's also going in and pouring into my residents. So one of the reasons also that I really love the smaller properties is because I have complete control of the ability to help my residents and to help them be better off when they leave living from me than they were when they came. So being able to teach them about their finances, if they're struggling with their finances, helping them find the resources and the tools to learn better to budget their money or to reach out to organizations that can help them. So really it's about making an impact with all the blessings that I have. I have time freedom now. I'm financially free. By the grace of God, if I never did another real estate deal, I could live the rest of my life without financial struggle. And I know that I'm tremendously blessed to be able to say that. So now I get to wake up every day and say, what am I here for? What impact can I make on other people? And if I'm rewarded monetarily for that, and I continue to grow my wealth by helping other people to grow theirs, that's great. But really it's the impact that drives me much more than any particular real estate deal or any particular, financial windfall that I might get.
Yeah. Yeah. It's such a, I, I look forward to being in that spot, but I just, the point of where you can really, make that decision every day, like, this is what I'm going to do, and this is what I'm going to do to have an impact, is just, I love when I hear people went to the Best Ever conference. I guess that was February. And there was one of the speakers just did this like talk, and it was just basically all about, that their company is impact based now. And I was like, that's the goal. That's just amazing to get to that point and be, every decision you make is not, okay, how am I going to pay the mortgage this month, or how am I going to, it's okay, how many people can I help? How many lives can I change? That kind of thing. So I think that's just amazing.
Absolutely.
Second question for you is, maybe can you tell us something about yourself that isn't common knowledge, whether that's a special skill or a hobby, something that maybe not everybody knows about you?
Sure. I sing. I love to sing. In my young 20s, I used to sing in a lot of clubs, and I won a nationwide talent search for a record contract in Nashville. And long story short, I didn't go. It was one of the dumbest things I ever did take in my whole life. But I love music. I love supporting musicians. I still sing a lot for my church and different weddings and things like that. And now I have a daughter that's a songwriter and sings. And so we've been working on some music stuff.
That's amazing. That's amazing. I love it. I won't ask you to sing and put you on the spot, but I do love music as well. So that's pretty amazing. When people hear this and they'd like to reach out to you, what's the best way to reach you?
Great. If you're an accredited investor and you're interested in investments that make an impact while growing wealth, you can find me at my website at greaterpurposecapital.com. If you're interested in coaching or speaking or a mastermind, you can find me at www.reimom.com. And I'm on social media, most of the channels as Anna Kelley, REI Mom.
Okay. And we'll put all of that in the show notes too, so that we have it. Final question, and I feel like you've given us so much good advice already, but what advice would you give to someone who's getting started, trying to make their way into the real estate business? What would you tell them to kind of motivate them a little bit?
Sure. I would tell you, don't be a lone ranger. Don't go it alone and try to figure it out the hard way. I went it alone and tried to figure it out the hard way. And I really didn't have mentors in real estate that could help me to fast track some of these decisions. The other thing is just stick with it. Believe in yourself. Determine today that you are going to have grit, because I can tell you, again, I don't have a crystal ball, but I think the next 2 to 3 years in real estate is going to be really, really challenging, as the last year and a half, where before you could find deals, but you couldn't find money. Now you can't find deals and money's really expensive. but that is not an excuse to stay out of real estate. Get started, take baby steps every single day, get to know your market and watch for shifts in the market, and network with other people that you can potentially partner with to help you continue to move the needle one rental at a time on properties that actually help you to meet your financial goals.
Yeah, that's amazing. That's amazing advice. Anna, thank you so much for coming on today. I can't wait for people to hear this one. I think they're going to love it. Appreciate all that you've shared with us. And for those of you listening, if you like this episode, and I'm sure you will, please go ahead and subscribe, help us get this podcast more reach. Again, thank you so much for coming on, Anna.
Thanks for having me.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.